My name is Madeline Norton, and this presentation is the evaluation that focuses on the current financial health of a business to give an educated accounting opinion to our friend David. The purpose of accounting information is to identify and measure economic information to assist in the decision-making process. Financial statements provide information on the management of resources, the economic health of the business in light of earnings, cash flow, and profitability. To assist David, we identify different types of business structure, the importance of assets and liabilities, and the future decisions in the financing of his business. As we look further into the information provided on the balance sheet, we discover that the profitability in business security is not simply found in the accounting equation, but can be evaluated by quality of stock. It is important that we take into account the limitations of accounting when helping David, and that there are many other variables such as social impacts and industry trends. Next slides following will be on the business structure that we think will be best for David to adopt.
Hi, my name is Sahil. My part on this presentation video is based on advising David for his business. So let's begin from form of the business. So I have some types of the business in my slides. So let's begin. Sole proprietorship. It is a kind of business where there is only one owner. So it is basically easy to set up and easy to shut down as well. No business tax, and all the profit are kept by the single owner. Some of the disadvantages are there are unlimited liability, and it is only handled by a single person, so loss of work, higher marginal tax rate on the surplus earning than the corporation. So let's talk about partnership. It is the agreement between more than two people, so the capital is being shared and also the responsibility as well. Profit and loss are shared within the shareholders. Some of the disadvantages are the only if one shareholder makes the mistake, entire whole business should suffer the loss, and there are unlimited liability and also potential of partnership disagreement. So let's go to the another slide. So it talks about corporation. Here it is the kind of business where it can raise the money and also have continuous lifespan, easy of ownership transfer with no mutual agency, and it also have limited liability. Some of the disadvantages of these types of business are ownership and management separation and double taxation. Startup costs and are higher. So let's move to the other slide. So here I recommend David to go for partnership business, as we know that David has less knowledge in this kind of field, so enlarge his knowledge. It is better that he would go with this kind of business, as we know that there are more than two people, so the business would be more easy to establish and the start up cost will also be low. There will be more capital in the business. He would have great borrowing capacity as well, or there would be a great opportunity for income splitting, and advantage of particular importance due to the resultants of tax. So let's move to the other slide. Here David wants some information regarding the characteristics of assets and also the liability. I have missed some points. They are listed below. So first of all, I want to read through characteristics of assets. Future economic benefits controlled by particular enterprises, occurrence of a past transaction or events. So similarly, characteristics of liability. Present obligation arise from past event, result in outflow of resources.
Hi guys, my name is Hasnan Zahid, and today I'll be explaining you guys current business worth and balance sheet. So let's go to the current business worth. According to David, business is worth $70,000, which is true to some extent. Normally, worth of business is equal to total assets minus liabilities, and in this case, total assets are 170,000 and liabilities are 100,000. which gives us 70,000. This is the quickest way to estimate value of a business. Furthermore, accounts receivables for the business are overdue by more than 60 days. Business valuation is practice of estimating value of business, and it is not just one amount. There are three commonly used methods which show financial worth of a business. Book value method is easiest, and it is same as the net worth. David has used book value method to get the estimated value of the business. Then comes present value method, where current and future cash flows are taken into account to get the value of business. Another one is fair market value, and it is price business is most likely to fetch in an open market. David should consider other ways to know worth of business, as there is not enough information available. Let's go to the balance sheet. So most of the inventory is obsolete stock, which means it is causing assets to reduce in value and create allowance on balance sheet. Cost of goods sold will be increased due to this allowance. Accounts receivable are asset for a company, but in this case it has been overdue for 2 months. Overdue receivables also come under allowance in balance sheet, and this overdue amount will be subtracted from other accounts receivable unless paid. Correct measurement process is the process used to control cash amounts at which parts of financial statements are carried in a balance sheet and income statement. It helps compare and evaluate financial data. Balance sheet is also known as a statement of financial position, and is a way of measuring profit. Correct measurement basis has effect on profit and assets. There will be a decrease in asset value and increase in profit. Recognized value when there is increase in asset or reduction of liabilities have resulted from inflow of economic benefits of these movements. It will also recognize earning process is substantially complete and can be measured.
Through the purchase of the business, it is important for David to consider his financing decisions. The two ways in which David could choose to finance his business could be through debt, which is a finance that is borrowed that you must pay back with interest within an agreed time frame, such as a traditional business loan, or equity, which is finance provided by the exchange of ownership for capital. The business that we are reviewing for David has an outstanding debt of $40,000. This implies that the proportion of the entity's capital has previously been provided by creditors and lenders, saying that it has a relatively high ratio of debt to equity. There are benefits to debt finance, such as maintaining ownership, tax deductions, and retaining profits. However, due to the outstanding $40,000 that's already there, it might affect the current credit rating of the business. Therefore, the banks may deny the loan, or they may increase the interest of the next loan. If a business becomes over-leveraged or the fixed assets become so high the business cannot pay, it could result in bankruptcy, resulting as debt being a negative impact. Therefore, I agree that David should choose equity as a form to finance his business. This will help due to the lessening burden of having to repay the debt and the ability to put the extra money of cash flow that would have been put into the fixed assets back into the growth of the company. As stated earlier in the evaluation, David lacks knowledge in certain business areas to which taking on investors could benefit his direction to grow experience and contacts. When analysing a future business prospect, it is important to look further than just the financial statements. as accounting information is only useful when its limitations are understood. Financial statements are just a snapshot in the moment in time and does not take into considerations social, economic, or political factors. However, after analysing David's business and the information that we are given, it is clear that it carries a lot of risk. With the information provided, the business has poor accounts receivable turnover, with being overdue at 60 days, and low inventory turnover with obsolete stock, both of which make up total asset turnover ratio that in the future will provide very little return. The result of this low turnover, in correlation with the debt to equity ratio mentioned in earlier slides, means the business has an incredibly high liquidity risk. With not having the assets to sell to generate the capital, the business might have to find new ways in order to reduce the discrepancy between the cash flow and the debt repayments. Therefore, I would advise against the purchase of this business due to the financial risk outweighing the future benefits in profitability and the lack of the financial health it currently possesses.